Welcome to Market Catalyst. I'm Jared Blikre. We are 30 minutes into the U.S. trading day. Let's get to the three market catalysts we are watching this hour. First up, investors now fully pricing in a rate cut in 2 weeks with the possibility of 2 rate cuts amid a weak jobs report, full coverage ahead, plus Broadcom shares surging amid strong demand and a new $10 billion customer said to be OpenAI. We're going to break down the outlook for the AI trade. And finally, Lululemon. It's sinking as a weakening economy and trade policies hit the retailer. All that and more coming up on Market Catalyst. And let's get a quick check of the market right now, taking a look at the major averages in the U.S. Over there on the left, you can see everything in the green right now. The Dow is the weakest among them, and I'll just show you a quick chart here. That's the intraday price action. We gapped up, and we're up only about 0.2%, but the NASDAQ flying higher. That's off of a Broadcom win after earnings yesterday. That's up about 0.6%, and the S&P 500 up similar to the Dow there, 17 basis points, and the big driver this morning, of course, that jobs report, 22,000 jobs. We're going to be breaking all that down, but here we have the Russell 2000 up 1% in the early going. And I got to show you what's going on with the bond market right now, because 10-year yields have been on the decline. The whole yield curve has been declining this week, but you can see it is now down to 4.08%. That is 10 basis points off of where it was yesterday. Here is the 30-year. It's down 9 basis points. It was close to 5 a few days ago, now 4.79. And let me show you the 13-week T-bill as well. Here's a year-to-date. This shows you how it is crashing. This closely tracks the Fed funds rate. This is the benchmark that we're talking about, expecting those rate cuts coming as soon as September, 2 weeks. That is down significantly, 8 basis points on the back of that report. We got gold surging to record highs, but now I want to show you the market sector action, and materials is leading the charge. That's up 1.33%, followed by real estate and consumer discretionary. All three of those up 1%. Then you got consumer communication services, staple and healthcare, and tech. Those are in the green. What's not working today? Financials. That's down 0.9%. And a real quick look at the NASDAQ 100. There's your standout. Broadcom after earnings surging 10%. We're going to be talking a lot about that today. And stocks are at record highs after that August jobs report as rate cut bets surge. Investors now pricing in a 100% chance of a cut at the September meeting. And now 50 basis points is a possibility according to the CME FedWatch tool. Joining me now is Gargi Chaudhuri and also BlackRock Chief Investment Strategist and Portfolio of the Americas. That's Gargi's title. And John Hilsenrath. He is a StoneX Senior Advisor and Yahoo Finance contributor. Thank you both for being here. This feels like a big day for the markets. We're seeing stocks at record highs, but I want to get, John, your reaction to the jobs report that we had this morning. Weaker than expected. You include the revisions to the downside of the 2 prior months, and we're not looking at that many jobs reported this month.
Right. I mean, the U.S. economy is not producing jobs right now. I mean, I think that's the most straightforward conclusion that one could draw. One would think, with the economy not producing jobs, that unemployment would be a lot higher, but it's not rising very much because the labor force is contracting, in part because of an immigration crackdown. So we have a job market that's basically stuck, dead in the water, so to speak. That does suggest the Fed is going to cut interest rates in September. I'm skeptical about this idea that they're going to cut by a 0.5 percentage point. I think a 0.25 percentage point is more likely. The problem for the Fed is, even though the job market looks weak, there's still an inflation problem. Inflation is almost a percentage point above the Fed's 2% target, and they can't ignore that.
No, they have those dual mandates. They have to balance inflation with jobs. Gargi, just your top level first blush reaction to the report that we got this morning.
Sure thing, and good morning. It's great to be here. So 3 things that I focused on this morning. Obviously, the revisions, especially to the June payroll, now turning negative, certainly sort of was a little bit eyebrow raising, but just the 3-month average now sitting below that 30,000 level, right around 29,000. I think that is meaningful. And to John's point earlier, it's just showing very strong slowing and cooling of the labor market. but not necessarily signs of job destruction. So that's number one. The second, I would say, when I looked at the details, just seeing weakness across very many sectors, I think that's really important. Pretty much the only area where we got some stability and strength was around that leisure and hospitality. So I think looking at different sectors, you're seeing job losses or not as many job gains across different sectors that I think is important as well. And then the last thing that I would say is just around, wages. Obviously, that's something that we've been watching because we like to see how they portend to inflation. And again, that wages number certainly still solid, but one of the weakest that we've seen over the last few months. So all in all, definitely very much pointing to a 25 basis point rate cut. But I think the chances of us getting more than 50 between now and the end of the year, so not a 50 basis point cut in September by any means, but maybe getting one more rate cut, I think that's going to go up. But obviously, we have to see a few more data points for that.
Data dependency, that's the name of the game. John, I want to switch gears just a little bit. Steve Admiron over in the Senate yesterday attempting to be confirmed for a new Fed position. We have questions of Fed independence lately kind of rising to the surface in multiple fronts. Plus, we have the Lisa Cook issue. She may be out as well. And this all kind of points to a Fed which may be much more dovish in the future. How do you put all of this together, John?
Well, I would make 2 points. One is it's clear at this point that the Trump administration is smashing all norms that the economics community, the financial community, the central banking community have for the relationship between a central bank and an executive branch of government. This is just not the way it has worked over the last 40 years. The idea of having a White House official keep his job while temporarily sitting over at the Fed is just not something at all that we're used to. The idea of firing a Fed governor without any kind of due process, not at all what we're used to. I think from the market's perspective, the Fed, if the administration has its way, is going to be a lot more dovish. I think from the market's perspective, that if the economy is really weakening as much as it looks, then a dovish Fed actually might be what's needed right now. So I think that's why you see the bond market reacting in a way that's pretty positive. What I would say is beware of inflation ghosts from the not so distant past and the distant past. We've got CPI numbers coming up in a couple of weeks, and they might be a reminder that inflation is still a problem and a dovish Fed might not be exactly what the economy needs right now.
And Gargi, I'll let you comment quickly on what John said about Fed independence, but I also want to know what you're thinking about this next CPI report.
Sure. So I think, obviously John covered the independence issue, but I think it's more about what should investors do about this. None of us actually know how any of this is going to resolve. We can all have our views, but how should your listeners think about how to invest as a result of that? And we just came out with our fall investment directions just earlier this week. And one of the things that we talk about is, number one, the need for inflation protection in your portfolios for various reasons. Certainly the stickiness of inflation, but obviously if there is some question on how dovish the Fed is versus what the economy requires, the release valve for that might be inflation moving higher. So owning some tips in your portfolio, hedging a little bit with gold as well, looking towards, obviously equities have historically been a very good inflation hedge, but where in equities, and again, here we're talking about continuing to focus on large cap and AI, which we think investors should continue to do. So it's the implication of all of this, the implication of the dovish Fed, focus on earning some income in the markets. And then to your second point, I'll say that, while we think about CPI, what I am watching for, maybe two important things that I'm going to be looking for, is continuing to see the trajectory of shelter inflation. Obviously, that is something that was very positive in the last two prints. So continuing to see if rent and OER, or the owner's equivalent rent component, are moving gradually lower. And the second thing is any signs of tariff, which have begun in a few areas within the goods component, continuing to see if there are perhaps an apparel or others where we're beginning to see some tariffs take hold.
I really appreciate those comments for the investor, Gargi. And John, thank you for your insights as always. And coming up, we are breaking down Broadcom's latest quarter and reports of its new partnership with OpenAI. Broadcom stocks surging higher after the company's latest results and forecasts. They impressed investors. And a report from the Financial Times is stating that Broadcom is now working with OpenAI to develop custom chips. And for more on this, I want to bring in Stacy Raskin, Bernstein Managing Director and Senior Analyst. Stacy, great to see you here. Let's start with OpenAI. We got a hint in the report last night. There was a fourth customer for Broadcom worth $10 billion. Then the FT story. What is this about?
That's right. So, I mean, if you look at the print, the print itself was good on the numbers. It was a modest beat and raise. I think it met the buy-side bogeys. But what was more important was what was said on the call around this for customer. Broadcom currently has 3 AI customers. It's Google, Meta, and likely ByteDance. They've had 4 other customers that were kind of prospects. What they said is one of those customers converted to prospects converted to an actual customer. It is widely speculated to be OpenAI. Makes sense that it could be. Importantly, that customer is likely to drive $10 billion of incremental AI revenue next year in fiscal 26. Their other 3 customers are also upsizing. And so if you sort of parse it out, they're probably implicitly guiding for AI revenues next year that are $40 billion plus. That is probably up triple digits, more than 100% from 2025. And then it also looks like it's probably, at least as far as the company's concerned, that it's not stopping in 2026 either, right? It looks like it's continuing these sort of trajectories into 2027. And so, I mean, numbers are going up materially on this. And it almost reminds me of what we saw with NVIDIA, like when their ramp really started and you started to get this massive inflection. We've seen hints of this over the last several quarters with Broadcom. It looks like it's finally opened up. And that's why the stock is up so much this morning.
Yeah, the guidance is just about shocking. And I'm glad you mentioned NVIDIA. Let's take it back there. You think about NVIDIA's moat in the AI space. Can Broadcom, how much does this move by Broadcom encroach on that, if at all?
Yeah, so I mean, it's clearly impacting the narrative today. Like NVIDIA and like some of the other like GPU stocks are down somewhat today. That being said, I think the question of who's winning or losing, the kind of ASIC versus GPU debate has been going on for a long time. I kind of feel like it's still the wrong question. To me, the right question is more, is the opportunity in front of us still large or is it not? Because I don't think that this market is mature yet. And if the opportunity is still large, I think that there's still plenty of room for both ASICs and GPUs to grow and the pie's getting bigger. If the opportunity is not big, then they're both screwed, right? So I think that's the more appropriate question to ask. I actually do think that the opportunity in front of us is still large. I think that we are still early in this AI infrastructure build out. And so I'm still like positive in general on the AI silicon and infrastructure space.
Well, let's build on that. What if AI falters? How much is diversification in their offering an issue for Broadcom, or do they not need to worry about that right now?
You mean in terms of customer diversification?
Customer diversification, but also in the chipset they're making, anything in their product line.
Well, so you have to remember, so they only have a small number of customers. Now, this is by design. Broadcom will only take business, ASIC business particular, if they're convinced that there's long revenue visibility and large revenue opportunities. They don't want to take business where that customer may potentially move it away to somebody else with the next generation. They want to make sure that there is a multi-generational roadmap. And so this is only the really, really big guys with large revenues who are willing to commit. And so that in some sense limits the customer diversification that they will have to only a few customers. But this is by design. It's not a consequence of anything else. This is what they want. Because of that, you actually have to worry a little less about volatility in the sense of customers moving parts back and forth, which you do see with some of the other ASIC vendors sometimes. Now, in terms of the rest of their business, like they sell lots of things. You know, they have a wireless business and a storage business and a traditional networking business. That non-AI semiconductor business has actually been quite weak for a while. It's kind of been bouncing along the bottom. We're still not seeing a ton of sign of pickup yet, but at some point that will pick up. Presumably that will be a tailwind at some point, although it's mattering less and less given how big the AI piece is. And then, you know, they have a software business. They bought CA and they bought VMware recently and a number of other software companies. That business is actually doing really, really well, and it upsided in the quarter. It's got, what is their software business has 90% plus gross margins and 70% plus operating margins. It's growing really well. And so there's some diversification on that front. Although I think at this point, what investors really do care about is this AI business. That is what's driving the story today.
And it seems like everything's humming on all cylinders here, and guidance is so high. Any execution risks that you can see for the foreseeable future?
I mean, I guess the bear case would be, that they're getting out over their skis by putting out these big forecasts. But I would say, that Broadcom knows this market better than anybody else. They've been making these what they call TPUs, but they've been making these ASICs, these AI chips for Google for over 10 years. Hock, the CEO, sits on Meta's board, so they clearly know what's going on. If there's anyone out there that can actually develop and deliver an ASIC at the speed that this customer for maybe OpenAI wants to do, Broadcom's probably the only one that could do that. And I'd also say, like the CEO, Hock Tan, they announced last night that he's actually re-upped his contract to stick around until 2030. So this has always been one of the big worries with investors. Well, people love Hock Tan. Is he going to leave at some point? He's not leaving anytime soon. So clearly he sees some reason to want to stick around like for the next at least 5 years. So I'm not terribly worried about execution. If there's anybody out there in the space that has like best-in-class execution, it's these guys.
All right, really appreciate that, Stacy. Learned a lot, and thank you for that. And all your markets action is ahead. Stay tuned. You're watching Market Catalyst. Let's get a quick check on the market action about 1 hour into the trading day. And let's go to the Wi-Fi Interactive here, where we see the Dow now down 200 points, or almost 44 basis points. Let's take a look at the intraday price action, because we were in the green when we started the show here at the 10 a.m. hour, but you can see it's drifted strongly down. And the NASDAQ very much in negatory as well. That's down about 11 basis points, had been in the green quite strongly just a few minutes ago. And the S&P 500 following suit. And real quickly, we'll get a read on the small caps, still holding their ground, but the S&P 600 approaching that unchanged mark, only up about 4 basis points right now. And then looking at the bond market, this is important because we've seen yields on the long end and the short end declining pretty strongly, still down about 9 basis points for the 10-year. That's approaching the 4% mark, 4.09% right now, and the 30-year 4.80. That's down 8 basis points today alone. And just a real quick check on the sector action. We have materials in the forefront. That's up 85 basis points, followed by real estate, staples, communication services, discretionary, and healthcare. All of that on the top row. To the downside, we got financials and energy. Those are both down more than 1%. Now time for some of today's trending tickers. We are watching Tesla, ASML, and AMD. First up, Tesla. Shares in focus after the board unveiled a record $1 trillion pay package for Elon Musk. The all-stock deal spans 10 years and only pays out if Tesla hits aggressive milestones, rolling out robotaxis, scaling vehicle deliveries, and boosting its market cap from about $1 trillion now to more than $8.5 trillion. Investors will get their say when the plan goes to a shareholder vote in November. And next up is ASML, the semiconductor equipment manufacturer getting an upgrade at UBS. Analysts at the firm raising the company from neutral to buy, saying that the negative headwinds have already been priced in. The chip tool maker's shares had fallen 12% in the 12 months through Thursday's close, and that's as the firm got caught in the crosshairs of trade tensions between the U.S. and China, its biggest market, by the way, last year. UBS analysts say now that the market is well prepared for a weak 2026, allowing the focus to turn to a potential inflection point in 2027. And finally, we have AMD. Shares of the chipmaker falling to their lowest level since July. The steep share price decline comes after Seaport Research downgraded the stock to neutral from buy with no price target. Recent supply chain checks point to AMD seeing slowing growth in its AI accelerator business, the firm tells investors. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. And we have Lululemon plunging after issuing weak full-year guidance, expecting a $240 million profit hit due to tariffs. The retailer topping second quarter earnings expectations, but falling short on revenue due to its weakness in its U.S. business. And joining me now is David Schwartz, Morningstar Senior Equity Analyst. And thank you for joining us here today. You know, I was sitting here yesterday and we were talking about American Eagle, and I don't know if that's in your coverage universe, but it was a very bullish story on some new trends that we're seeing in Western wear and denim. And then we look at Lulu, and there's not a lot of optimism around these results. Just break them down for us at a high level, please.
Yeah, we've certainly seen a lot of mixed results from apparel companies in the last few weeks. Lululemon yesterday reported disappointing sales in the second quarter. Its earnings were fine, but the sales were light. But more importantly, the company greatly reduced guidance for the rest of the year for a couple of reasons. One was that Lululemon admits that some of its core products are not selling very well. Lululemon perhaps has oversaturated the market with too many colors and too many similar products, and right now they're not moving as they normally do, especially in the United States, and so U.S. sales have dropped off quite a bit. Lululemon is also being affected by tariffs, like a lot of other companies in this industry. It imports its products, and the tariff impact is going to be greater than what we originally expected 3 months ago. So there was some bad news yesterday from Lululemon. We're also seeing some weakness in the sportswear market generally. We've seen some difficult reports recently from Puma, for example, and Nike has been struggling. So there's been a number of things right now that have really been negative for Lululemon, and the stock price reflects that.
You just mentioned the product mix, among some other things, and I want to kind of focus on that. It seems just walking into the store nowadays that it's kind of all over the place. You mentioned a lot of different colors, a lot of different styles. Some are not selling as well as others. What is the company planning to do about that specifically, if anything?
Yeah, sure. So Lululemon has had a lot of turnover in its product development side. Its chief product officer left last year to go to Vans, for example. And so there's been kind of a lag in new products, but the new products have been selling well. It's really been the core products that have perhaps dropped off. I think that's due to competition. We've seen some very strong competition in women's athleisure, especially in the last couple of years from companies like Vuori and Alo Yoga and others, and that has affected Lululemon. We're also seeing, just I think some fatigue from the consumers where they go into a Lululemon store and they see kind of similar products. So what the company is going to do is they're going to increase their innovation. And so by next year, really spring of 2026, Lululemon is planning to have a lot of new products on the market and on the shelves. And so, I think that consumers will respond to that. Traditionally, Lululemon has had some down periods before, but when it's come out with new products, they have found customers. The brand is still very popular, and people are looking for new products from Lululemon, just like from everybody else in this industry. And I think that Lululemon will deliver that.
I want to ask you about their cash position right now. It looks like they have about $1.2 billion in cash, no debt, but they're also set to have buybacks on pace to exceed $1.1 billion. And I understand companies sometimes do this to offset share-based compensation. They're paying their employees in shares, but is that the case here? And given the fact that the stock is down so much, it was trading above 500, is that the best use, do you think, of this cash position?
Yeah, I definitely think it is the best use of the cash. Lululemon really has no other use for cash at this point. Doesn't pay a dividend. It isn't making acquisitions. The one large acquisition that Lululemon ever made was a company called Mirror, and it was pretty much a disaster. So I don't think that Lululemon is going to be making any more acquisitions anytime soon. So stock buybacks right now are really the best use of cash. When Lululemon stock was at over $500, as you mentioned, I had it as being very overvalued. I was one of the few at the time. Now I actually think it's very undervalued. My fair value estimate is around $300 a share. So I think that stock buybacks at this point are a strong move. Lululemon is going to be able to reduce its share count by millions of shares. So it isn't just buybacks to offset dilution. It's also buybacks that are really going to add value for shareholders. And I think that this is the right time to do it. And Lululemon has the cash flow to go through a lot of repurchases with no problem.
Last question here. I want to address tariffs because we've seen that hit a number of companies. How much is that affecting Lulu, and especially as we head into the holiday season?
It's affecting Lululemon quite a lot. Although there is some weakness in the sales, most of the margin degradation that Lululemon talked about yesterday is actually from tariffs. The tariff impact is going to be a lot greater than expected. But, that could be only transitory because there's a possibility the tariffs could be ruled illegal. And then that would certainly be a boost for Lululemon and other companies in this industry. But also, I think over time, Lululemon is going to be able to adapt to the tariffs by moving production to different countries and also changing its shipping policy. policies. Lululemon kind of unexpectedly is being affected by the elimination of the de minimis exemption because Lululemon does ship products from Canada to the U.S. That actually were not being hit with tariffs. So Lululemon does face some margin issues from that right now, but I think it may only be short-lived.
All right, really appreciate that. And we got to go here, but thank you for stopping by, David.
Thanks.
And we have all your markets action ahead. Stay tuned. You're watching Market Catalyst. Hewlett-Packard Enterprise beating revenue estimates driven by server demand. CEO Antonio Neri spoke with Yahoo Finance executive editor Brian Sozzi as the company doubles down on AI in the hybrid cloud. Let's take a listen.
We had a very solid quarter. We posted record-breaking revenue with expanded profitability on a sequential basis. And that's without and with Juniper, which obviously make it stronger. So overall, we had a very strong performance. And that was driven by strength in each of the key segments we participate, which, we saw double-digit year-over-year revenue growth. We saw expanded operating profit dollars in each of them. And then in server and hybrid cloud, we also expanded operating margin. But what really excites me, obviously, is the fact that we see a strong pipeline. We closed the Juniper acquisition and position us for what I call the next HPE chapter, which is going to be all about networking, hybrid cloud, and AI.
What do you envision HPE's role in networking? Because you're going up against some really big heavyweights.
We're going to be a market leader. Our goal is to build the best networking business on the planet, period, end of story. That's the goal. And fundamentally now we own the entire technology IP stack in that layer of the technology stack, which means we own the silicon, we own the operating system, we own the infrastructure, we own the software, we own the services, we own the security parts related to networking. And so when it comes to AI, and depending on the segment you participate, particularly in the large build-outs, we are going to lead with networking for AI. And Juniper already has some very strong marquee customers. And with HP, we can open those doors to new markets where today they have no ability to compete. So that's a big opportunity for us. But then when you look at the campus and branch business, which is basically the on-ramp to digitization and eventually inferencing, we believe that's an opportunity for us. And both companies, Aruba and Juniper Mist AI, have tremendous momentum, and both are winning in the market. So when I look at our portfolio, we have an amazing opportunity ahead of us, and that's just networking. Think about networking integrated with the rest of the portfolio. My view, that's not only is going to increase the relevancy with our customers, but also increase the shareholder value over the next 3 years.
Antonio, you want to issue any public challenges to Cisco? I mean, you could here on Yahoo Finance if you want.
Well, look, they're already taking notice what's happening, but I respect every competitor. Not for nothing, they have been market leaders in many of the segments of the market. But the reality is that we have way more assets than they do beyond networking. And that's the opportunity for us. We can compete in the pure networking market, but the way we deliver that value to customers is not just through networking, it's through integration with server storage, a private cloud, and our GreenLake platform, which is a point of significant differentiation for us.
Done like a true maestro. You subtly got your point through. I know you're a competitive guy, just like those F1 folks on the grid there, Antonio. So when you have you talked a lot about on the earnings call about this investor day, this analyst day that's coming in October, and you really made it a point to highlight what Juniper has coming. So when we hear from the Juniper folks, when they hop on that stage, what does their product roadmap look like over the next 18 to 24 months?
Well, you have to wait for October 15, but I will tell you there are 4 key distinct segments where we have focus and prioritization of investments going forward. Number 1 is the campus and branch. And together, Mist AI and HP Aruba networking, we have what I believe the best solution for our customers across all verticals: hospitality, entertainment, healthcare, manufacturing, financial services, and the like. And that's because both companies took a very modern approach when it comes down to cloud native and AI-driven solutions. And you can see that through the announcements both companies made in the last 3 months. At HP Discover in Vegas, we announced HP GreenLake Intelligence. That's a framework where we bring agentic AI to everything across the company. And Aruba introduced the Mesh AI solution together with our OpsRamp observability capabilities. Juniper last week introduced the Mist AI agentic approach that extends from the campus and branch all the way to the routing business and in between the data center switching. So there, I believe we will be a #1 vendor down the road, and we are already #1 in wireless, by the way. I think some customers and the street may not know that, and you can see that in the Wi-Fi orders intake. We saw this past quarter, we grew triple digits. So I believe there we have a very strong presence. And data center switching, Juniper had record performance. They grew double digits, high double digits year over year, and that's because of the AI pull through. And that also benefit the routing business, because when you build these large AI data centers, you need to lay, the pipes, which is basically the leaf and spine connected to this large amount of GPUs. But then you need a router to interconnect with the rest of the world. And Juniper has done a great job providing an integrated experience. So those are two, right? And then you have security. And security is very important both at the edge with SASE and then in the data center with firewall and the latest AI-driven technology. So we have a very complete portfolio, Brian.
Well, now I don't need to come to Analyst Day. No, I will continue to follow it. Antonio, before I let you go, this remains a very uncertain time on all things tariffs. I'm sure you saw the court's decision on President Trump's tariffs. If tariffs were to go away in mid-October, what would that mean for a business like an HPE?
Well, I don't believe tariffs will go away, are here to stay, and is a rebalance of the global trade. We believe we have adjusted to the new reality extremely well. We communicated yesterday that the net impact of the tariffs were already announced or in the works is just 2 cents. I think for us, the most important aspect of that is to continue to rebalance our supply chain, to continue to modernize our processes, to be more efficient in our supply chain, and then ultimately see what happened with 2 very important provisions. One is the semiconductor 232, because that's an important aspect as you import commodities into the United States. Today, semiconductors are excluded. And then the USMCA agreement, which obviously is coming up for discussion sometime end of 2026. But let's remember that HP has a very vast and diversified supply chain. And we as a team have done a great job maneuvering around it and continue to deliver the value, which we saw to expand the profitability this quarter. And then ultimately provide a guide, I think is what the street expected. But most importantly, we're going to provide a framework how we're going to create value for the next 3 years in October.
Being a smart investor means different things for different generations. How should younger cohorts like Gen Z and Gen Alpha play the market to set themselves up for financial success? And how does the calculus change as investors approach retirement? Let's bring in Lawrence Sprung. He is a Midland financial founder and author of Financial Planning Made Personal for this week's FA Corner, brought to you by Capital Group. Larry, thank you for joining us today. And so let's start with this generational kind of difference in objectives that Gen Z might have a different objective than someone nearing retirement. So let's cover the younger ones first. How should they plan for the long term?
Yeah, so I think the younger generation has a great opportunity amidst volatility, right? The older generation may not feel that way. Younger generation, great opportunity because they could invest more money, lower prices, take advantage of that volatility, and long term, they'll probably be in a great place. Dollar cost average bringing their prices down. So when the markets do rebound, which they typically do, they'll benefit greatly from that.
And dollar cost averaging just means adding money periodically. It could be on a schedule or whatever, no matter what the market is doing. How about the older generations nearing retirement?
So I think they have to be a little bit more cautious, right? And I think the important thing for them is if they haven't figured it out, they should really look at their portfolios and understand, is my portfolio aligned with my age, my goals, my risk profile, my time horizon? And they should do that when the sun is shining. It's always easiest to repair the roof when the sun is shining, not when you're in a storm. So make sure you have that set up in the proper way. If not, get it aligned with those factors.
Let's take an asset class like bonds, for instance. A lot of times you hear people nearing retirement need more bonds in their portfolio. It pays an income. It pays a coupon, and so that's regular money you get. And it also can prevent or can play a part in diversifying the portfolios. But what about younger investors? Do they need that bond exposure as well, or should they just be in NVIDIA?
Yeah, I mean, I don't know that they should be in NVIDIA, but I don't know that they need to necessarily be heavily invested in bonds either. Again, if they have the time horizon and they have the ability to watch their portfolio, typically an equity-heavy portfolio is better for them. Diversified, not all in one security. Having a diversified portfolio is going to put them in a great position long-term if they have that time horizon.
All right, we have markets at record highs today. I'm talking about the Dow, the NASDAQ, and the S&P 500. But what about when the market pulls back a bit? How can investors use that to their advantage?
So there are a couple of things to look at, right? One thing is tax loss harvesting, which basically means, hey, look at your portfolio during the year. Are there losses within the portfolio? Meaning, are there things, items, equities, or bonds that you can sell, capture that loss to help mitigate your tax implications for the year? Great opportunity to do that. Any dip, you should be looking for those opportunities.
And what about IRA Roth conversions? Because I believe that ties into the dip theory as well. Maybe you can break that down for me.
So Roth conversions are great if they make sense for you. Basically, taking IRA money, traditional money that you put away tax deferred, you can then convert it to a Roth IRA. You do pay taxes on that conversion process, but basically you're taking money that you're going to be taxed on later on and converting it to money that you're not going to be taxed in the future. So the whole idea is, as the market dips, you then do that conversion when those assets are lower. Essentially, you're paying either less tax or you're converting more because of the lower value, and then you're going to get that growth and that tax-free growth over time going forward.
All right, now I like to focus on risk management in particular, and just thinking about some behavioral guardrails. As people see news come in, they might see a stock or a portfolio item that they have drop considerably, or they might see a very bullish headline. How do you advise investors, especially who are in for the long term, to think about news and to kind of prevent them from being a little bit too trigger happy?
It's like any emergency situation that we've been talked to and trained about, right? The first thing you do is pause. Take a deep breath.
Yes.
Stop, drop, and roll, right? That was what we were always talking. Stop, pause, take a deep breath, right? If this is something that you are in control of yourself, understand what those sales may do to your portfolio long term. If hopefully you're working with a financial advisor, reach out to them and have the conversation. The reality is, if you've done the work and your portfolio is aligned with your goals, your risk profile, et cetera, you're probably going to be fine. I think what we forget in those moments are that volatility is the toll that we pay as investors to grow our assets over time.
Very well put. We got about 30 seconds left. Any last words for investors?
Don't get nervous. There's always things going on, and you have to understand, are you a trader? And if you're a trader, obviously the day-to-day is much more valuable and important to you. If you're an investor, zone it out, pay attention to your portfolio, make sure it's aligned with your goals and objectives, and long-term, you should be in a great place.
Larry, really appreciate that here. Thank you for joining Lawrence Sprung for today's Capital, brought to you by Capital Group. And coming up, full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. Coming up on this hour of Market Catalyst, first up, full jobs coverage ahead as the labor market shows signs of slowing. How is AI impacting hiring? Plus, we push ahead to the next economic reading. The Fed will watch CPI. And Tesla proposing a $1 trillion pay package for CEO Elon Musk. We're going to discuss that and more on Market Catalyst. And 90 minutes into the start of U.S. trading, I'm Jared Blikre. Let's get a quick check of the markets. Taking a look at the major averages, we have reversed. We hit record highs on the open, but now everything is in negative territory. The Dow down about 0.75%, and the NASDAQ and the S&P 500 trailing those just slightly. But we got to talk about the jobs report right now, because August jobs is boosting rate cut expectation for the Fed's September meeting. So what does the Fed need to see from next week's CPI report to make that cut a reality? Joining us now is Diane Swank, KPMG U.S. Chief Economist. And Diane, thank you for joining us here today. We've been talking about the jobs report all morning, and I'd like your first blush reaction to it. And also, I know one of the things that you look in particular toward is the longer term, the broader unemployment gauge. That U6 number hit 8.1% from 7.9%. What does this all mean for investors?
Well, basically, that's the highest number since October 2021. That's really something going in the wrong direction. What we're seeing is those people who moved from 15 to 26 weeks of unemployment fell into those moving with 27 weeks or longer on unemployment. And that's a sign of stress in the underlying labor market. So what we're really looking at is not only has job growth slowed to less than 30,000 a month over the last 3 months, we could see different revisions, but at the end of the day, this is a weak job number, and there's cracks forming in the labor market. What we're seeing is sort of a freezing effect, almost like a winter in the labor market, where those who have a job are frozen in place, unable to hop to new jobs and get better pay, and those who are out of work are unable to get into a job. So you've got those frozen in place and those frozen out in the labor market right now.
Yeah, we've definitely seen a trail of negative reports, or surprisingly negative reports on the jobs front over the last few weeks. I want to talk about Fed rate cut expectations, because it looks like September, one rate cut is a cinch right now, so that'd be 0.25% taken off the Fed's benchmark rate. And now even 2 cuts is getting priced in for that mid-September meeting that we have in a couple of weeks. But those odds are pretty low right now. What do you think the rates cuts are for going forward, like September, October, December? Do you think we get 2 or 3 by the end of the year?
I think we get 3 by the end of the year now. The Fed is very worried about the employment situation. Sort of once it starts to slow, it can slow very rapidly. Now we've seen this sort of very moderate slowdown over the course of months, but we're within the range of statistically not different from 0 or negative at this point in time. We also had that revision to June showing the first negative month in June, moving it into red ink since December of 2020, when we almost slipped into a double dip recession before we had yet another round of stimulus to get the economy going and reopening in 2021. So this is a worrisome situation. It does take away some of the pressure, even though inflation is likely to come in hot next week. It suggests that the weakness in the labor market is enough to erode those inflation pressures over time, and that's what the Fed will count on. The bottom line is, with these revisions, it now looks like the Fed is late on rate cuts, but they put themselves in a no-win situation, having to wait for the data to come to them and then having revisions to the data showing that the economy in the labor market in particular is much weaker than they originally thought.
Yes, data dependency is indeed a two-edged sword. I'm glad you brought up the CPI report for inflation next week. What are you expecting overall? And I know you just said that you don't think it's going to change the calculus at the Fed that much because they have other concerns in the labor market, but what are you going to be looking for in some of the subcomponents and just generally there?
Well, what we've seen is a move up in goods prices related to the changes in trade policy and tariff increases. Those have shown up in goods prices, which had been a deflationary component of the CPI, holding inflation down. We're also starting to see some services inflation come back. And that's going to be really key, because that's something the Fed does not want to see. They wanted to see a cooling in services as some of the tariff effects went through, bumped up prices. It's not a one-time bump because they were sequential increases increases, but the Fed thought it could look through some of those increases. But if it sees continued strength in service sector inflation, which is running well above what it was in 2019 and well above what's consistent for the Fed's target of 2% inflation growth, that's a problem. And one of the reasons that's occurring is because of inequality is worsening. Lower and middle income households, we had the lowest number of people out on vacation in August, second lowest on record. The lowest on record was August 2020, and it was half the historic norm. People are not doing discretionary spending except for affluent households. So even more of spending is concentrated in the top echelon of income earners, and that is a very difficult situation for the Fed because it could create some inflation in areas it doesn't want to see it in the service sector.
I'm glad you touched on that disparity there. I want to switch gears and ask you about what you think is happening in the bond market right now. If you look across the yield curves, yields have been coming down somewhat aggressively over this 4-day week here, the holiday shortened week. We had the 30-year nearing 5% just a few days ago. Now it's at 4.78%. It's down 9 basis points. That means investors are piling into those bonds and also some of the on the short end of the curve. How do you put all this together? What does this mean for investors?
Well, what we're seeing in the bond market is the idea that the Fed is finally going to cut, and that being much more of a reality now. And that is helping to bring it down. Also, just the weakness in the overall labor market gets us closer and closer to flirting with recession. And that's something that the Federal Reserve certainly wants to avoid. Jay Powell wants to avoid. Given that they hope that this is, just a little bit of an extended period of elevated inflation and then comes off because you hopefully don't get it sustained, given the weakness in the labor market. And that's where I think you're seeing in the bond market is now you're seeing this sort of pullback of weaker economy, more rate cuts. It's coming down in some ways for the wrong reasons.
And Diane, you mentioned the R word, so I do want to bring that up. Recession. What's your big yellow, orange, red flag there? What makes you think, okay, now recession might be likely?
Well, it's really hard when you have job numbers this close to zero because basically they're not statistically different than zero or negative. That said, the household survey did show more job gains, a lot more job gains. So we're still encouraged by that. But there's one indicator we tend to watch, and again, it's being distorted by the weird sort of economic environment in. We did see the long-term unemployed at its highest level, since 2021. The long-term unemployed, that is important because as a share of the civilian labor force, it usually only rises in a recession. And last month it actually picked up it picked up in the month of July. It likely came down a little bit because the civilian labor force expanded again in the month of August. But this is a very weird situation where we're seeing the civilian labor force, the supply and demand for workers are both slowing in tandem with each other, which is helping to hold the unemployment rate near historic lows. So even though we went up to 4.3% on the unemployment rate, that was because more people were actually putting their hat in the ring and looking for a job.
I really appreciate that explanation and also bringing it full circle here. Thank you, Diane, for your insights. And all your markets action is ahead. Stay tuned. You're watching Market Catalyst. We've taken a broad view of Wall Street and the job market this morning as August unemployment or employment data came in weaker than expected. But let's now focus in on Main Street and check the pulse of small and medium-sized businesses, plus how AI is likely to change the landscape. Joining me now is John Waldman. He is a Homebase founder and CEO. John, really excited to have you here. We've been talking about jobs all morning long, and I'd be interested to know, because of your unique lens into these small and medium-sized businesses, what you think of this morning's payrolls report and any data that you're seeing. Are there any disparities that we should be concentrating on right now?
Yeah, thanks for having me. I would say the report this morning was pretty consistent with the data that we see across 150,000 plus small businesses and 2 million plus workers looking at these trends in real time. What we saw this morning first was that payrolls were essentially flat, and that so were wage rates. And that has been pretty consistent with what we've seen over the summer, which has been a pace of caution from small businesses really going back since the start of the year.
Well,
yeah, go ahead.
I'm sorry, go ahead. You were about to break some stuff down.
Yeah, I was going to say, second, we saw the downward revisions in the historical numbers, and frankly, that was very much expected. We have been seeing that caution all year, and so that was not a surprise at all. I think the one thing that was a surprise for us under the covers here was that we saw a 17% jump in turnover and a 10% jump in hiring. And so while the overall numbers were staying relatively flat, we were starting to see a higher level of churn in the system.
That's interesting. We were just talking to an economist, and she was talking about the market being frozen on both sides for certain groups of people, people who are looking for work and also people who are trying to get workers. Anything you're seeing like that in your data?
Yeah, we serve small businesses, and they're subject to a lot more seasonality in the hiring that they do. But the other thing that's true is these are businesses that respond very quickly. That's one reason why the Main Street data that we provide has been so predictive of these larger trends, is because small businesses are very quick to react to changes. And so when we see them operating with caution in the face of economic uncertainty for most of 2025, that's not a huge surprise. When we see them potentially recalibrating their teams a bit in this current opportunity where there is a lot of seasonal turnover, that's maybe not a huge surprise either.
And let's break it down by some of the sectors. I'm reading your report right now, and you in particular note that entertainment and caregiving are facing stronger headwinds.
Yeah, I think some of that's normal with the seasonality on the entertainment, but I think it's consistent with, frankly, what your previous guest was just talking about, which is, some concerns in the softness of consumer spending. That's going to flow through to things like entertainment. And again, small businesses operating in these categories are going to be some of the first to respond to that.
And what about some of the indicators like temporary work and wage growth? Those are things that we always look at in the BLS monthly report. How does that compare to what you're seeing in your data?
Yeah, I think that's something everybody should be paying attention to. I thought it was quite notable in July when we actually saw the average hourly wage decrease month over month, which is something that we hadn't seen for a long time and really off trend for the last few years. And so I think as we look at the slight decline last month and basically flat this month, I think that is actually telling us that something significant is changing in the labor market.
All right, and let's talk about AI here. There are a lot of fears about AI coming for jobs, and of course they're going to create some jobs as well, but the headlines is usually when jobs are being lost to this new technology. How do you see that evolving in your data set?
Yeah, you remember back in 2021 when everybody was talking about the K-shaped recovery and you had these really divergent paths on the economy. I think that we might be in the midst of seeing something like that again, very divergent paths. In large companies, we are hearing a lot of talk about AI-driven layoffs. In small businesses, I do not think that is what you're going to see. I think AI is a profound enabler for small businesses. Already we are seeing record growth in new business applications. That's been really strong for a while. But break down what is ahead. AI is a fundamental time saver for small business owners who are so stretched. And I'll give you a recent example.
Please.
I was talking to a customer who is using our AI-driven hiring assistant to create their team as they open their business. They interviewed over 64 applicants in the first 24 hours. That saved him over 30 hours of time and was an incredibly fast hiring process. You can't tell me that AI is not going to be an enabler for growth for very busy small business owners.
Yeah. Sorry to interrupt you there. And I was just going to add, AI really helps businesses navigate all kinds of complex regulations, fill out forms. What are some of the other areas where you see AI really enabling small business owners, especially in a regulatory environment where regulations are kind of being cut right now?
I think you're pointing at one of the most important things and where the biggest gains to small business growth are still ahead of us. Right now, small business owners get to harvest the benefits of time savings and all of these incredible things that AI can bring to them. But we know that one of the incredible limiters to small businesses and entrepreneurs is the incredible complexity of starting a business. Anything that can reduce that complexity is going to enable more entrepreneurs to pursue their dreams. And I think that is the great promise of AI ahead, where AI is going to be that true enabler, when it can really reduce that barrier in handling all of the complexity and regulation and just the operational hurdles of starting a business.
Yeah, and John, I agree with you. We are just at the beginning of this big AI ramp. Thank you for joining us. Appreciate your insights.
Thanks for having me.
And all your markets action is ahead. Stay tuned. You're watching Market Catalyst. Let's get a quick check on the market action about 2 hours into the trading day, and we have a big reversal underway. On the open, we had record highs in the Dow, the NASDAQ, and the S&P 500, but we have sunk into negative territory. This is the Dow you're looking at, down about 262 points. We are off the lows, but as you can see there, deep in the red. NASDAQ, very similar situation, although off a little bit less, 1/3 of 1%, and off of its lows as well. And the S&P 500 down about 0.5%. Now, let's take a look at the sector action here, and we have real estate. I didn't mention that bond yields are kind of crashing right now. That bodes well for the real estate market and REITs, and we have those up 0.8%, followed by staples. So that's a little bit defensive there. Following that, we got materials, healthcare, communication services, and consumer discretionary, just barely in the green for that last one. And what's not working today? That would be energy. XLE down about 2.18%, followed by financials on its heels. And I should also mention that industrials and utilities here down 0.8 and 1% there. And I just want to get a quick update on the semiconductors, because you can see Broadcom in the center of your screen. That is up 9% today, off of the highs, but a huge win for the chip maker as it gains OpenAI as its fourth big customer. And what's positive for Broadcom is negative for NVIDIA. You can see it's off about 3.5% right there. And now time for some of today's trending tickers. We are watching Broadcom, UiPath, and Guidewire. First up, Broadcom. Surging after a blockbuster quarter, the chip maker posted record revenue of nearly $16 billion, up 22% from a year ago, fueled by a 63% jump in AI sales. That's about $5.2 billion tied directly to artificial intelligence. The company also raised its outlook for the fourth quarter to $17.4 billion, topping Wall Street estimates. Investors are also watching reports of a $10 billion AI chip deal, widely believed to involve OpenAI. Broadcom shares hit an all-time high on the news. And next up, we have UiPath. It's on the move after a robust second quarter earnings beat. The automation software leader posted earnings per share well above street estimates. Meanwhile, revenue came in at $362 million, up 14% year over year and exceeding consensus. The automation software company was helped by momentum with its agentic artificial intelligence offerings. That prompted it to raise its full year revenue outlook after swinging to a profit in its latest quarter. And finally, we have Guidewire. Shares are up over 18% after the software company reported earnings. The insurance software provider said it sees fiscal 2026 revenue of $1.39 to $1.41 billion, higher than Wall Street forecasts of just below $1.36 billion. Guidewire reported fiscal fourth quarter adjusted earnings of 84 cents a share on revenue of $356 million, topping expectations. And you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. And Tesla is making headlines again, this time with a record-shattering proposal for CEO Elon Musk. The board is offering a performance-based package worth up to $1 trillion over the next decade, tied to big bets on robotaxis, AI, and pushing Tesla's market cap value to $8.5 trillion. To break down what this means for investors and whether Musk can actually deliver, we are joined by Jed Dorsheimer. He is William Blair's Group Head of Energy and Power Technologies. Thank you for joining us here today. The numbers are mind-boggling. $1 trillion in the bank just for Elon, but he has to get the Tesla market cap up to $8.5 trillion. And I remember this is kind of similar to a pay package that was in the past and was disputed. Just kind of fit all this together for investors so we can wrap our heads around these huge numbers.
I mean, honestly, I'd like to see more pay packages like this, where, to be clear here, this is not some type of golden parachute if Elon were to leave. If he does not hit these milestones, he does not get paid. So it really, aligns his interest with shareholder interests. And so while the numbers are staggering, I've never seen a number this large, but the value creation, 7.5 times the value that the shares are currently valued at is huge as well. To me, there's a couple things that jump out of these tranches. The first being is really the scale of robotaxi. I mean, if I look at the increase in auto sales, it's only about 150% increase from what they've delivered so far. But the 1 million commercial robotaxis in operation, to me, that's something that really jumps out and says that because that's where we think most of that potential value creation could come from. And the second one is which is not directly tied, but that XAI investment that's on the table going into the vote. So those are kind of the two things that jump out.
We have seen Tesla share price, the stock price, rise and fall with the troubles and travails and successes of Elon Musk. And it's so dependent on this one person, this head, Elon Musk. What do you think is this a good thing for the stock? Because maybe it encourages him to spend more time in Tesla. And then is it, maybe not the best thing for some of his other ventures?
I mean, it locks him in for 10 years. So yeah, I think that if I was to talk to shareholders of Tesla, they're thrilled. And you're seeing that in terms of the market action as well. But I think that this, shows a complete commitment to Tesla, where there may have been questions around how much time he's allocating and where the focus is. So I think this very much aligns. I mean, I think, and listen, we have a pretty balanced approach on this. Regrettably, we moved to a market reform, earlier in the summer, largely on really on the regulatory tax credits, which haven't flowed through. And so you're going to see a margin headwind here in the near term. So there will be a valley that's created. And I think, the question will be how many shareholders look to the optimistic opportunities here and the alignment of innovation that this pay package does versus near-term results, where this quarter, things will probably see a pull-in and better than expected, but you're going to see a gross margin headwind and probably cash flow headwind from those regulatory tax credits, which will start showing up in Q4.
Let's talk about some of the levers that might potentially catapult Tesla to this $8.5 trillion valuation that we're talking about. Big one is robo-taxis. How do you see that timeline? How do you see that ramp evolving from here?
I mean, we went to Austin. It's now open to the public in the Bay Area and Austin, Texas. We went down to Austin last month. Certainly hit a nerve with our feedback, but we spent a day just doing ride after ride and talked about what our experience was, which was positive. Critics are going to push back and say, well, it's not real autonomy because there's a safety driver that's in there. And that might be fair. However, you have a very different approach here, one that's probabilistic, which means that it's going to have a much lower cost basis. So Tesla is taking a end-to-end neural net approach with a vision only. And critics will say, well, that's not safe. And that the Waymo, which is a deterministic approach, the challenge there is that you've got high costs and what is the scalability? What is interesting is with only a couple months under its belt, Tesla has already eclipsed Waymo that has been in terms of area of coverage over the past 5 years. Now, again, it shouldn't be an apples to apple because the Waymo, doesn't have a safety driver in there, but Tesla is deriving these results. And if they are able to effectively check the boxes from a safety perspective and prove this out, then their cost basis is, in our calculation, 1/10 that of Waymo. And so in that case, winner could take all from an autonomy perspective, which would increase the value of that business tremendously. And I think that aligns with what we're seeing the board point out here. And then there's probably also a follow through in terms of Optimus, because you're deriving that, that's a training model that you're deriving that data, and how do you scale that beyond just autonomy? And that's really where you start to get the value creation here towards those milestones.
Yeah, the IP mode, as it's called. I want to ask you, we only got a few seconds left, the relationship between Elon Musk and Donald Trump, it seemed to be a detriment to Tesla's share price earlier this year when we had customer boycotts. Is that a thing now that there is some distance between the two?
I mean, I think you're seeing that show up most notably in Europe, which has not been good for Tesla. So from a brand perspective, I kind of think that that's a bridge that's crossed. I don't think that all of a sudden people are going to come back and say, we want to, I still think that you split around, party lines where, I think that, I think for, maybe say it this way, Tesla just needs to provide the best product. And as they provide the best product for the best price, I think some of that will abate. But I don't think that they'll get any benefit in terms of political affiliation. And the more that Elon sidesteps and doesn't get involved in that, I think it's probably beneficial to the shares.
All right. Appreciate your candor here and all your insights, Jed.
Thank you.
All your markets action stays ahead. Stay tuned. You're watching Market Catalyst.
Fashion-forward start to football season. Just ahead of the NFL's 2025 kickoff, Abercrombie & Fitch announces that the brand is an official fashion partner. That's a first for the league. Executive editor Brian Sozzi sat down with A&F's CEO Fran Horowitz about that deal.
Super exciting announcement that we made last week. The first official fashion partner for the NFL, a first for us and a first for them. An opportunity, honestly, Brian, for two iconic global brands to come together. Their fandom and our consumer are very in sync. We stay very close to our customer, keep them right at the center of everything that we do. And several years ago, they told us how important it was for them to attend sporting events, to watch all sports, but particularly they love the NFL. And so we started a very authentic relationship about 3 or 4 years ago, just with 5 teams. We had terrific success. We now carry all 32 teams. We started in men's. We've now added women's. We've added kids. We've added pets. So it's grown incredibly. So the next step was to form this partnership and become an official fashion partner for the NFL.
Am I wrong to think this is partly a social media play as well? You have led the way in the mall with social media marketing, driving a lot of buzz and excitement around the products and the assortments you've dropped. I mean, is this another way to get into that crowd?
100%. This takes us from being a licensed partnership to a true marketing partnership. The opportunity for brand awareness, the opportunity to be as you say, fairly aggressive on our social channels. We actually can now participate on NFL.com and the NFL channels. So that's another big opportunity for us to be able to bring a lot of brand awareness and bring in some new customers to the brand who may not have thought of us so far.
How did you select the players that you did?
We have a lot of player love. Trust me, it was not an easy decision because there's many, many players that we'd love to partner with. We've picked several that have just been super excited about the brand for many years. Again, we like to go with authentic, genuine participation from the players. We've also got the wives and the girlfriends that have worked with us for the past few years, and so you'll be seeing some of that coming up as well. I don't know if you know, but almost 50% of the NFL fandom is female. So this is an opportunity to hit, men and women consumers as well.
I've talked to you for many years, Fran. I think I can touch this rail, so hang with me. One of your competitors had an earnings call today. It was an American Eagle. They're in the same malls as you. In some cases, they're across the way from you. Whatever the case is, they said they are gaining traffic because of their new partnership with Travis Kelce. I mean, were you in the bidding for Travis Kelce? I mean, was this something you just lost out to American Eagle? Did you want to get involved with him? What has gone on here?
What we have is the first official fashion partnership with the NFL, which is pretty incredible. And again, across many players, many wives, many girlfriends. We also signed a deal last week directly with the Dallas Cowboys. Mm-hmm. That's going to open up some terrific opportunities, both at the Star as well as AT&T Stadium, to be able to sell product within their shops, as well as some activations and some events this year. So we've got a lot of exciting opportunities ahead this season. So stay tuned.
Are you surprised that of the we've been doing retail for a while, Fran. I mean, the popularity of these Star platforms, and not only what I just mentioned with your competitor, but I was talking to a PVH. They have an underwear campaign with Bad Bunny, and they saw sales of men's underwear up double digits. Like, why do these celebrity partnerships still work?
Well, I think it's actually interesting that it's shifted a bit. It's really about sports and fashion coming together in our culture. I mean, these are big moments where the fandom is just so excited to follow their teams and follow their players, that it's become just very much part of the culture. And we're so excited to be at the intersection of all of that.
There was a big turn in your business in the most recent quarter, the Hollister business. Now, you've told me this repeatedly, Brian, it's about to turn. It's about to turn. You had a very big quarter in Hollister. Why has that business now moved what looks to be beyond an inflection point?
So that consumer and our team are just completely connected. It's so exciting to see the team just dialed into that consumer. We have actually had several quarters of success over the past year and a half. But yes, Hollister had knocked it out of the park for the first half of the year, 19% growth on 19% last year. It's being close to your customer, Brian. It's that product, voice, and experience coming together. They've been doing several collections that the consumers actually asked us for, things like going back to our heritage. We did a Y2K relaunch for back to school as one of our drops that the consumer loved. We did something for homecoming that really resonated with their lifestyle. So there's lots of reasons for the consumer to come and shop with us. We are really staying close to them and really understanding what matters.
Lastly, Fred, retailers in the second quarter, it was still a challenging backdrop for many companies. They didn't really get hit with the tariff, but a lot of folks I talk to now in the industry are saying now we're at that point where retailers are going to have to raise prices for back to school if the stuff is already in the stores, but most certainly for the holiday season to offset the cost pressures they're seeing in the business. Have you had to take those actions as you have planned your holiday assortment?
So we have publicly said, no, we haven't. We are not intending to take broad-based ticket pricing in the back half of this year. Our goal is really to offer our consumer the best value for the product and the fashion that we can and quality that we can put out there. We have managed over the last several years, Brian, lots and lots of challenges. We have a very resilient playbook. We're putting that to use. We've got a few levers to pull. The last one, frankly, that we want to pull is pricing. We really want to stay close and appreciate our consumer and give them what they want.
What's your favorite NFL team?
I am a Giants fan, as is my family.
They're just not doing good, friend.
I love all 32 teams, Brian. I've had business to do with all 32 teams.
Fine,
yes, on Sunday.
But you lean
on Sunday. I will be
lean towards the Giants. They need to win. Like as someone sitting in here in New York, the Jets are just awful. We'll take it offline. I had to ask you that. We got to ask these tough questions here at Yahoo Finance. Fran Horowitz, Abercrombie Fitch CEO, talk about this new NFL deal. Really appreciate your time as always. We'll talk to you soon.
Thanks, Brian. Appreciate it.
Shares of real estate technology company OpenDoor have risen to a 3-year high, up nearly 300% this year and over 900% since the beginning of July. But what exactly is OpenDoor and what's behind the massive rally in its shares? Founded in 2014, OpenDoor became a high-profile player during the housing boom. And here's how it works. Homeowners can go online, enter their address, and receive an instant cash offer directly from OpenDoor. If they accept it, OpenDoor buys the home, makes necessary repairs or updates, and then relists it on the open market. But the model is risky. Holding too much inventory when home prices fall can mean big losses for the company, and that company has struggled with profitability, posting steep losses in recent years, even as demand for easier and simpler home sales is growing. Now, enter Eric Jackson, a hedge fund manager famous for his big bet on Carvana. He took to the social platform X in early July, laying out his thesis for the company to reach $82 per share. The post triggered a resurgence in the so-called meme stock rally, and it has prompted volatility in OpenDoor shares ever since. Yahoo Finance sat down with Eric Jackson to discuss why he's so bullish on the stock.
I think global residential real estate is the big, and buying and selling your house is the big untapped market. And so when you think of, in the US alone, that's a $20 trillion market, and 14 trillion of the 20 trillion is tied to people that are tied to a mortgage. And so that's the opportunity.
Amid the resurgence in the stock, its CEO, Carrie Wheeler, has stepped down. The company is now hunting for its next CEO as it looks to capitalize on the momentum sparked by retail enthusiasm. So what is OpenDoor? It's a disruptor trying to modernize one of the oldest industries in America, but one still searching for a path to sustainable profits. And tech leaders including Mark Zuckerberg, Sam Altman, and Tim Cook, they attended a dinner at the White House where President Trump warned of substantial tariffs on semiconductors from companies that don't produce domestically. The president saying, quote, if they're coming in, building, planning to come in there will not be a tariff. Yahoo Finance's tech editor Dan Howley is here. And so, Dan, how much are these tech companies relying on building personal relationships with the White House? We've seen this play out time and time again.
Oh, yeah, big time. I mean, this is, they're playing the game just as, well as the next. Tim Cook kind of was the poster child for this in the first Trump administration, managed to dodge tariffs for the most part on the company's most important products, the iPhone, things like that. But now we're seeing the other tech executives kind of start to mimic that with the second Trump administration. And this comes after, the issues that came about with the attack on the Capitol on January 6th. Afterwards, Trump was banned from social media platforms. Then, he sued them. He said he would jail Zuckerberg as a result. And since then, the companies have started to, continue to warm up to him, and especially in the lead up to the election, we had seen, Zuckerberg praise him, Sundar Pichai, the CEO of Google, praise his McDonald's stunt, and then others kind of followed the same path, and so this just continues that. They donated to his inauguration. Tim Cook was at the White House to announce new investments. All the companies have announced some kind of investment. Obviously, they're trying to avoid those tariffs on semiconductors that are going to go into place. Trump had bandied about the 100% number. So, the relationship with the White House is of key importance to these companies, and they're going to continue to play the game.
I want to talk about Apple here. Tim Cook was at the meeting, but really I want to talk about the stock price, which has been on the move higher recently. Alphabet got a favorable antitrust ruling, and that kind of gave Apple a boost because of its tie-in with the search engine. But what about the iPhone here? We got the Apple is set to debut its latest phone models. So what do we know about the lineup so far, and especially the pricing?
Yeah, the iPhone 17 is expected to launch on September 9th. I'll be out there in Cupertino, California at Apple's headquarters, checking it out live. The big deal here is going to be, obviously, if there are any price hikes. Analysts are anticipating $50 on the standard models, the regular lineup or the Pros, and then the new iPhone Air, which Bloomberg's Mark Gurman has reported will come out. It's supposed to be thinner than the original phones or the standard and Pro phones. It'll replace the iPhone Plus model. That's been the weakest seller in their standard iPhone lineup. And so this is going to be basically a redesign of the phone to have a thinner body. It will, however, lack 3 cameras. It'll reportedly come with just 1, which is a downside, I think, to consumers, as well as a thinner battery, a smaller battery. So we'll have to see if Apple's able to work some kind of software wizardry to make sure that the battery life is up to snuff and it doesn't kind of act as a turnoff for folks. But that could see a $100 price bump over the prior Plus model. So, this is something that we're going to be watching closely. They're also expected to launch their latest Apple Watches, and we're expecting to see some AirPods. Those could have heart rate sensors in them for the first time. Apple's Beats brand has already done this with their prior Beats headphones. So we'll just have to see if we get those in the AirPods finally.
And we got like 20 seconds. Anything else on your radar here?
Yeah, I think one of the things to watch out for is if we get any kind of artificial intelligence announcements. Usually Apple saves that for its WWDC software event. This is something that obviously Apple has been kind of hard up when it comes to AI. Wall Street's been kind of, banging the drum that Apple's falling behind. And sure, they don't have the capabilities that Google has, but I don't think consumers mind at this point.
All right. Really appreciate it, Dan. And guess what? That is it for Market Catalyst. I'm Jared Blikre. Thank you for watching. More Yahoo Finance is ahead.